Good afternoon, everybody. It is the Intuitive Investor from StockTwits. Today is July 1st. Just enjoying this very hot and muggy weather here. Thought I'd maybe do another update. Last week I had done a couple of updates on IQ and a few different stocks. There was a little bit of a market sell-off, and that scared some investors, including myself, to the point where I was really questioning what to do with my portfolio. I'm one of those types of investors that likes to keep my portfolio pretty clean and simple. So it's not abnormal for me to have less than 3 to 5 stocks at any given time. So let's get right down to it. What we saw, that is, on June 15th, we saw the 10-year jump into 3% territory. As you know, the 10-year bond is one of the markers, one of the symptoms, one of the measures by which we can sort of figure out if market confidence is high or low. Typically, the higher it goes, then the higher the confidence. And it jumped into 3.1 territory on June 15th, which was a Friday. And so over the weekend, when we came back, then it triggered that market sell-off that we saw happening right around June 20th. And the only other time where we had saw that be in 3% territory, looking back, was back in 2016. I have some of my data here, so I'll be looking back and forth on my computer. So we also looked at the Dow had peaked January 29th, and 5 months later we're still 2,000 points under that. And since then it looks like the Dow has been trading sideways. Now the NASDAQ, we look at the beginning of the year and we're at about 7,000, and today it's sitting a little bit over 7,000, 7,500 and change to be exact. So we're doing better than the Dow. Looking at the S&P, it was sitting just under 2,700 at the beginning of the year, and today it's just over a pinch of 2,700. So that's kind of been trading sideways for all those 500 companies. Our recent sell-off in June 20 saw a lot of stocks across all of those markets drop. And so one of the questions that I began to ask myself, as a lot of investors were asking across the boards on StockTwits, was how does this happen? How do all stocks from all different sectors collectively together come down? Monkey see, monkey do? I don't know, possibly. Is there some kind of secret society that controls all the markets and says, guess what, guys? June 20th, we're all going to go ahead and sell tons of our stocks across the board and trigger a market sell-off because the market's been hot too much. Stocks are getting too expensive for us, and so we need to trigger a sell-off. Who knows? Possibly. Maybe the paranoid side of me thinks that there's a group of 6 or 7 different heavyweights, just like in the movie. So money never sleeps. If you remember that scene where everybody's sitting there and making decisions about where the market's going to go, I don't know. So anyhow, so there is this sell-off, and what does that mean in a bear market? Questions about what's the difference between a correction and a sell-off. Simply stated, a sell-off and a correction are kind of like in the same thing. It's when a stock or the market drops more than 10% in a short time. Short time, I think, if you guys want to agree, would be probably within a day, 2 days, a week. I think that if collectively a stock dropped 10% over the course of 2 months, let's just say it dropped 0.5% per week until it accumulated 10%, I don't know that I would be as convinced. I would say that that's probably still trading sideways, and some stocks have been known to trade sideways for long periods of time. If you could see the S&P, case in point, collectively together they've been trading sideways since the beginning of the year. So bear markets, when a stock turns bearish, one of the criteria that I had read, because I began to question myself, I began to see a lot of bearish remarks on StockTwits and different avenues, and everybody was talking about bearish, bearish. In order for a stock to become bearish, from what I gathered, it had to have sustained at least 2 months of sustained bearish activity. So I don't know that a correction makes a stock bear. Think of like what happens in the day-to-day market, more like the weather, how it could go up and down, temperatures rise and come down, and think of whether a stock is bullish or bearish market, however you want to say it. It's more of the general climate, just like we have the 4 seasons. So, all right, let's take a look. I also wanted to talk briefly about the kinds of stocks that can thrive in corrections. Last week I was just crazy busy, so I wasn't able to do updates or engage in some of the rooms as often as I wanted to. But from what I was reading and from what I was hearing, some of these analysts on CNBC is kind of like where I go to a lot. But I also do some stuff on different websites. Was when the market goes down, that's when you want to buy. That's the general consensus. I can understand that, but I'm also not 100% bought in with that, because no one knows the bottom, and no one knows how long a stock is going to go down, and no one knows that if a 5% dip can graduate to a 10% dip and therefore trigger a recession or a correction. No one knows that. I think ultimately you just have to decide on what you're more comfortable with, whether you're comfortable buying when it's trading sideways or when it's coming down, or if you're going to wait for a dip, or if you'd rather just buy whenever you feel comfortable. I'm that type of trader where if I feel good about a stock, I'll buy it, and I just won't really try to be tactical about squeezing the last penny out, because for whatever reason I'm investing in it. I believe in the stock. And for those of you who don't already know, I am intrinsically a bullish investor. I invest. And so bearish investors is kind of like an oxymoron, because bearish sentiment or bearish mentality or bearish psychology is more about wanting a stock to lose its value. And that's the opposite of investing. Investing is more for growth. Yes, we could philosophically argue that they're making money on the downturn, but I don't know. I just don't agree with it. But anyhow, bears make money, bulls make money. Anyhow, so some of the stocks that I was looking at, because I wanted to find out the next time there's a correction, I want to make sure that I'm in on it, and I want to make sure that I want to be able to buy the right kinds of stocks, especially if numerous stocks are dropping together, sort of the monkey see, monkey do analogy. How do we know if thousands of stocks are coming down and some of them are dropping 5, 10, 20%? How do we know which ones had a verifiable drop and which ones were the ones that were dropped just due to the noise? And due to the noise for me is just stocks that lost their value and were crushed just based on what was happening, sort of like collateral damage. Not because they actually did something, because they're just part of the market. So, in researching, I find stocks that have nothing to do with the root cause of the correction is very pivotal. Case in point, tariffs on Chinese products. Anything Chinese is affected, even if it doesn't import anything to the United States. This is a big one, because while tariffs on China suggest anything that's imported from China to the United States, but there's products like IQ who's not importing anything, yet somehow collateral damage is affecting them. Why? Because they're a Chinese stock. That's something that you want to look at. When you find out the root cause, is it directly affected, or is it just a victim of the noise? So here's another thing. Maybe the Dow is down, and that in turn affects the NASDAQ stocks. This happens sometimes. Look at what was happening earlier in the year in this other market sell-off from a few weeks ago. all the markets were red, and that affected parts of Europe and China, and everybody was red. It's just everybody was red. How does that happen magically all on the same day? That's just interesting to me. And so when you get down to the root cause of what caused that sell-off, you have to figure out, is my stock affected? Is it part of the play, or is it just, it's all part of the noise? Remember that term. Just, is it noise, or is it fundamental changes to the stock that caused that to go down? There was this thing that had came up for me, since I'm more of a tech investor, and there was this thing that I had heard that tech stocks usually sell off in the summer, and it was weird. And so I did a little bit more research, and I found out that there is this phenomenon called the sell in May and go away, and sell in May and go away. And where that came from was, I guess, way back. Investors had this thing where they would buy all their stuff from January to May. They'd go on vacation, and then they'd return. They'd return in September, and that was kind of where that phenomenon. So when they went away, markets dropped. Don't know where that came from, but I don't know if it's still happening. But I kind of was looking at some of the data, and I do see some lulls right around that time. So it's important for you guys to realize that some of your stocks might experience just these random tech sell-offs, or these random sells in biotech, or whatever it is that you guys are putting your money in. You might experience these lulls in the summer. Then there's also this research that was done by a psychologist known as the Halloween effect, which showed that stocks perform horribly right around October. And I guess the psychology behind that was just that it's one of the more depressive months. I don't know how much weight I would put into that, but again, this is just information for you guys to look at. I mean, the more you learn, and the more you read, and the more you try to understand the markets and the markets that you're involved in, the better you're off. Don't be that investor. There's these types of investors that just buy on the fly, and if the stock goes bad, they feel defeated, and then they just walk away from the game. And then you have these other investors who make mistakes, and they pull their money out, and they get back in the game once they're healed from their losses, but never bother to really reflect on what had happened, what went wrong. And that's why you have to be the third class of investor, the investor who learns as much as you can about the stock. Not that you're going to have like this crazy amount of knowledge about tradings and technical analysis, and you're not expected to do that unless that's your profession. You're not expected to do that. I certainly don't put that on myself because I have my own thing. But you learn, and you learn whatever it is that you're investing in as much as you can, so that you are smart about your money. You're smart about putting your money in the right places. You have to believe in what you're putting your money on. So by doing that, and if your stock tanks, or it crashes, or it corrects, take a pause, analyze what happened the days prior to that, try to learn about as much as news, Wall Street sentiment, technical analysis, and put it all together and help make sense of why your stock went the way it went. And then this way you could probably time market sell-offs, corrections. If there's one thing that I've learned is for Shopify, for example, that's a stock that I've been following since it IPO'd. I've noticed that that's by far one of the most reliable things I've ever invested in. And what I see is right around maybe 2 to 3 weeks before it reports its quarter, I see an uptick in volatility, and then usually it settles right after it reports, and then it goes on these bullish runs that just seem to go on forever. So analyze the habit of your stock is one way of understanding what your stock is going to do before it does it. and knowing when to get out. So, and then I also look at stocks. There's two different classes of stocks. There's the ones that you trade and the ones that you marry. It's kind of like dating, actually. Although I've been married to my wife for 23 years, so I'm a little bit out of the game. But stocks you date are the ones that you're in, you're out, you're in, you're out. No pun intended, but you may stick with them for a few weeks or a few days or a few months, and then you do, and then you're out. And you might go back, but you're out. Whereas a stock that you marry is a stock you don't trade. You just buy and you hold, and you buy and you hold. That's going to be sitting into your account. So it's important, I think, to really understand yourself as a trader and figure out what kind of a trader you want to be. Do you want to be a person who's always dating, right? Or do you want to find yourself a stock that you just want to accumulate, or several stocks that you want to just accumulate, or a balance of the both? I have a healthy balance of the both, and I like it that way. But anyhow, one of the last points that I wanted to bring up was the VIX. The VIX is something that I had mentioned in the previous video, and if you noticed back on June 20th, right around to the end of last week, there was a lot of volatility in the market, and that caused that stock to spike up, I think close to $10 or $15. So I think that stock, if you saw a market sell-off, would be a great thing to get into for a very short time and then get out, and then just get out. It'd be a quick way to make some good money. But again, I don't buy VIX. It's just not my thing. But if you're looking for something that's short term to help you out, if the market is volatile, chances are your stocks and my stocks and everybody's stocks are not doing well. So this would be a good way to sort of soften the blow. Other than that, I think that's pretty much all I had for the day. In wrapping up, I'm still not convinced that we've recovered from whatever exactly we went through June 20th. I think for me, as I had posted on the boards, I'd want to see at least another week of stability. So that's July 2nd, July 3rd, 4th of July we're closed, and then the 5th and the 6th. I'd want to see some sustained growth there. I'd want to see that there isn't any crazy moves down to feel more comfortable and to just overall feel better about the markets. So again, knowledge is power. Educate yourselves. I know the video went longer than I really wanted it to, so I do apologize. My intention was just to really touch on what had happened, explaining the difference between sell-offs and corrections. I know some people were asking about that on the boards. For whatever reasons, I mean, the moment that the stocks come down 5 points, 10 points, 5%, 10%, these bears, where do you guys come from? I mean, can I get a bear to comment on that? Like, where do you guys come from? Like, they come out of the woodwork, like, and it's interesting because they rejoice when a stock goes down. So that's where I'm just not a fan of that. Although I have to realize that there are a lot of fad stocks out there. Fad stocks are the kind of stocks that really have no substantial growth behind it, but for whatever reason they just get pumped up. I was part of that early on when I had bought into GoPro and Fitbit. I think Fitbit is ahead of its time actually, whereas GoPro, I think it's just very limited. But yeah, I made some mistakes. If there's any advice I'm going to give to the bears before I go, I know this video is crazy long, is stay away from stocks that have really good Wall Street sentiment. Stay away from growth stocks. If you can stay away from a growth stock and one that has good positive Wall Street sentiment, you will do very well, because you cannot beat Wall Street sentiment. It's a collective zeitgeist, emotion, whatever you want to call it. It's too much for you to just be that 5% that votes against You're just going to lose. What I would recommend you do is go bearish on a stock that's dying. Go bearish on a stock that Wall Street hates. You would do very well there. So until then, I will see you guys soon. It's the Intuitive Investor. I'll see you on StockTwits. Don't forget to add me and follow me. And if you have any questions about any other stocks that you'd like for me to check out and look at, you could find me there, or you could send it through YouTube as well. All right, take care. Enjoy the rest of your Sunday.